A trade-in is regarded as a single transaction that involves the swapping of an old business asset for a new business asset. Equipment and vehicles are the most common assets traded in. Generally, a trade-in qualifies as a like-kind exchange, discussed earlier. Using the like-kind exchange rules, the taxpayer can avoid the luxury auto limitations. On the surface, a trade-in seems to follow the sale and subsequent purchase of qualifying property. Occasionally, two separate contracts are executed with a vehicle or equipment trade-in, and for record-keeping purposes, the purchase and sales transactions are unrelated. However, the IRS has held that the sale of used equipment or vehicles and the purchase of new equipment or vehicles are reciprocal and mutually dependent transactions. Therefore, they are subject to the like-kind exchange rules. Business assets that are traded in have specific rules regarding the calculation of depreciation in the year of trade-in and subsequent years. Generally, a trade-in qualifies as a like-kind exchange. However, taxpayers can elect out of like-kind exchange treatment to maximize depreciation deductions in the year of disposition. When a business asset is traded for a new, similar type of business asset, a new asset is created with a cost basis equal to the boot or other value paid to acquire it. The traded asset will continue to be depreciated over the remaining recovery period. Let me give you an example. Judy uses a van exclusively for business. It cost her $15,000 when it was new, and as of this date, she has taken $9,450 in depreciation, resulting in an adjusted basis of $5,550. Then she traded it in on a new van. After some serious negotiations, she and the dealer agree on a price of $17,000 for the new van. The dealer then gives her $7,000 as a trade-in on the old van, and she signs a note for $10,000. She then gets a dealer's rebate of $500. Her depreciable basis in the new van is the $17,000 less the $7,000 trade-in and the $500 dealer rebate for a net basis of $9,500. However, she will continue to depreciate the $5,550 basis of the old van on its original schedule. The $9,500 basis of the new van will be depreciated on a brand new depreciation schedule. Adjustments can be made in the basis of the property exchanged. The basis of the property received in a like-kind exchange begins with the adjusted basis of the surrendered property and is then increased by the following: any money given by the taxpayer, adjusted basis of boot given, debt the taxpayer assumes, and any gain that had to be recognized because of boot and transaction costs paid by the taxpayer, unless used to offset the boot. The basis is decreased by any money the taxpayer received, fair market value of boot received, loss recognized, and any debt of which the taxpayer was relieved.